Hey folks, this is ACAT with charts for sharkcharts.live, and this is part 3 of my ACAT mini-series focused on compression moving average. A compression moving average is two sets of bands on this chart. It's the purple band with the rose mean, and the green sets of bands with the magenta mean. The purple set of bands is the tracked longest compressed period. The green set of bands is the current longest compressed period. This set of bands is less intuitive as to what we're tracking and why, as just measuring the longest overextended period with mean reversion moving average. And in practice, there's a lot less reason I've found to want to slice and dice it compared to tracking the longest overextended period. It gives a lot of good information to use in parallel with mean reversion moving average, because it's giving you information about what's happening at the same time that you're really nowhere close usually to a pivot as defined by the longest overextended period. So on this video, I'll first go through the theory behind this, because longest overextended period was well covered in the previous videos, the wave PM, 3D wave PM, and if you've pretty much ever watched Dad Shark's live streams, compression moving average is new. So we'll go over the theory. I'll then go through a few examples of actually using it and just the compression bands, and then I picked out some charts that are good illustrations of using both compression and mean reversion bands to identify different stages of volatility cycling and trending. So I am going to start, though, the same way I did with the previous video on mean reversion moving average, with a chart that has managed to max out the longest compressed period. Its warning color is cyan. It's actually not that common to see this maxed out, but this was a 1700-ish overexpansion, if you'll recall. So it's not too surprising that it then maxed out the compression that happened in response to that. So if you see this, please either move to a higher time frame or set this band to hide until tracking resets and turn on the higher period length bands. That'll give you this picture, which I have plotted alongside 3D wave PM to start explaining what we're looking at all. And you'll note that this is 815 period length for the tracked longest compressed period, so it's actually not particularly close to 600 max, and the previous set of bands would have been completely misleading. So whereas with the longest overextended period you get these fairly distinct plumes that have a pretty distinct endpoint usually, compression works a little bit differently, where it's a bit like hot and cold or light and dark, where one of the two sides is not so much the opposite as it's defined by the absence of the other. So cold is the absence of heat, dark is the absence of light, and in this case, compression is really the absence of mass and volatility. As a result, instead of just giving one clean pivot, you get these very elongated compression bands that run quite far sometimes. And this is the point at which it gets past 600 period. This is not very easy to track by hand with 3D wave PM, and you'd need much higher resolution to do so, which is a good time to bring in an algorithm to do it for you. The basic theory here is that what's happening at this border and period lengths is that overexpansion above it is still in the sweet spot for trending and still expanding on those period lengths and generally moving in one set of directions. But everything that's happening under it, now that you've compressed it and the local movement is not in agreement with the overexpanded movement, well, when you get up to this border and you try to expand volatility again, you're not necessarily going to have the period lengths doing the same things on either side of this border. So it becomes a pretty difficult pivot to expand past. This is the concept of volatility overhead, basically. So this allows us to define a set of pivots that should be relevant as places where it's just very difficult to expand volatility further. And practice, it does so quite well, which is why we made the indicator. So the green set of bands is tracking what's currently the longest compressed period in its range. In this case, all the way from 14 to 2000. And the purple bands are tracking from wherever the highest period length was when it stopped having a highly compressed reading, which is blue on 3D wave PM. It'll just continue tracking that period until it sees mean reversion or similar reset trigger. Once it starts tracking something, it just works similar to mean reversion moving average, where it resets when you cross it, or if you set it to a different criteria for resetting. During the part of the compression range where there isn't anything being tracked really, you'll get alignment of the tracked longest compressed period and the current longest compressed period, because the furthest out thing that tracked longest compressed period is seen is also the current longest compressed period. But you then get over into some type of expansion, and now you're tracking 815 period length on tracked longest compressed period, but you're still getting compression underneath it. And that means it's going to be on a substantially lower period length than it was all the way back here, and substantially lower than the current tracked longest compressed period. So all along the way we have this expansion and we're still tracking. We're getting all these smaller compression ranges marked on the chart because those happen to be the current longest compressed periods. So I've in this set of charts just separated out the two sets of bands to illustrate this better, that in this area the tracked longest compressed period is very similar to the current longest compressed period. And all along this way, the current longest compressed period, when it's only tracking shorter things on a higher time frame, it's showing you relatively less information and relatively more time restrained information. It's only actually giving you information some of the time. In this next set of charts, I've taken the liberty of setting the 2.2 and 3.2 standard deviation bands in addition to the 1.25. And I've done that on several different time frames. I just want to walk through what it typically looks like to, when as price approaches these bands. So, and it's especially clean usually on higher time frames. we see that this midpoint pivot is very important. The bands at 1.25 and either side are frequent targets. 2.2 and 3.2 are also pretty frequent targets. They may see them tagged less often on higher time frames where they represent substantial price movement. Here, where price was in the 3,000 to 4,000s, this is all the way up at 5,000. So with the current longest compressed period green bands, you see this mean get respected here, or repeatedly wick it from that side. When I cross down, we wick it from the other side a whole bunch of times. We backtest it, and it serves as a general midpoint of price action, despite the fact that it's actually tracking an increasing period length the whole time. Eventually, we come from one side of the compression range all the way to the other. In this case, we didn't test further down to further deeper levels, but we did eventually have a volatility pop from the 3300s back to the midline, which got us compressed again on some of these period lengths. Then we crossed the place we ultimately rejected was the 1.25. And then from there is where we started having the real move that set trend in motion. Tracked compressed period, I think, is really actually well illustrated in this area, which corresponds to the November drop, November 2018, in Bitcoin USD. Where with the compression bands, it's a lot more common than it is with the mean reversion bands to test closer to the mean, in my experience. You should also be aware that the normalization method for wave PM is going to be a bit less precise, picking an exact compression boundary than it would be for picking an overexpansion boundary. So it's not surprising to see more chop at the actual pivots it picks out. Mostly, though, it's giving us a set of lower period bands that work similarly to LuxP and are pretty well respected than LuxP could, because LuxP was tracking a very high period length in this area. So at this point, it's probably best to just look through a couple other time frames. If we look at the 1 minute, which will generally follow the bands, it helps a lot to be using an extremely liquid ticker. But it's not necessarily going to be enough movement that it makes sense to trade it given fees and slippage. It still follows the basic rules. We see a movement, a volatile movement, and then we start compressing it. This is a pivot. It wicks it, goes to the other side, wicks that, ranges back down. Eventually it ranges up, and where it finds resistance is the 3.2. It ends up breaking compression and staying on that side. That doesn't give us a particularly nice overexpansion here. And this is the other word of warning about going way too far down a time frame of this indicator, is that it's just frequently not liquid enough to get good breakouts that are actually tradable if you go all the way down to the 1 minute. 5 minute is going to be a bit cleaner, and these will get cleaner and cleaner, generally speaking, the longer the time frame. Here we see a compression, tag, generally speaking, would want to be betting during a cresting period that we're going to go to the other side of the compression range. There's a couple good things illustrated at this size that may not be immediately obvious. This particular spot and this one, you actually get volatile moves out to the 3.2, but then once volatility is expanded, you actually get a rejection there, and the major move is counter to that. So you should not assume that just because when you break compression range, you're on one side of the mean or the other, that we're going to get continuation on that side or the other. And if you had bought the lower pivots here, you should have taken profits on this side, because it is entirely reasonable that the breakout move reaches the high pivot over here and then reverses. And you're not really going to know until it happens. But if you took profits, you secured your trade, and if you happen to have the correct final direction, you have perhaps could have part of the position that gets to keep following it with an extremely good entry. So as we start to go to 15-minute and get cleaner, you'll notice that in general, compression pivots start to get a bit straighter. This is a really good example, honestly, of early trending. Again, more common to see back tests that get to the actual mean of the longest compressed period before rejecting it. And we in fact see this trend continue a couple cycles of tagging lower bands, bouncing, going back to the mean, rejecting, before it finally mean reverts. Mean reverts here briefly, but quickly continues. But eventually you'll get a new compression range that'll develop out of large expansion, because eventually the expansion has to stop someplace. And at that point, you've got tradable pivots to start trading the range. If we move up to 60-minute, it should get even cleaner. And yeah, here the pivots are much straighter and much cleaner. Let's see a good example here where we start. We have tags on lower bands. We climb, and in this case, we expand in the direction of the breakout without volatile rejection. Tag 3.2, exhaust. Do it all again, except this time we break out down in the same direction. Do the same thing again, we get a longer compression range here. On this one's very nice. You get tags of the 3.2 standard deviation. You get really clean places to sell that position back at the other end of the compressing range. And then it reverses and starts breaking out in the same direction in this case. So I think that illustrates the general concept where you get this fractal pattern of compressing and digesting a previous volatile move. That defines a really nice compression range on this side of the indicator, and then at some point you get the breakout, and it will generally respect the compression pivots at least early on, before there's necessarily a clear overexpansion pivots as well. I would say that as long as it's in a range, you would probably want to have a strategy that assumes you need to take profits at the other end of the range, and that you can't presume that just because a breakout appears to be happening at one end of the range or the other, that you won't get a volatile reversal move. So now I've started to pick out a few good charts to use mean reversion moving average and compression moving average side by side. I'll start though let's go back to the BTC USD 4 hour that we started with. I've had on the splash screen for the series. We got some actually really good examples out of this in early 2019 and late 2018. When this larger area loads again, you'll recall that this was a very large overexpansion. And for all of this area here, it wasn't giving you any real information to go off of. It was a very high period overexpansion. But because you have the compression pivots here, you've got an additional way to define local trending. When we're so overexpanding that we're trading outside the 3.2 standard deviation of the longest overexpanded period. When we finally start reaching out to bottom levels where there are volatile dead cat bounces, that is when we start to create what's really a very large compression range, and very wide from top to bottom, and it just takes several months to digest this high period length overexpansion. We cross the pivot for mean reversion here, and key here, I think, is that it's not like these pivots stop working. It's where they're confluent with each other that is often particularly predictive. And that's a general observation, and I would make across time frames as well. So we get this local overexpansion. It tags 3.2 of that, and it tags the top of this 1.25 compression range that has served as roughly the top for months. We stay in this compression range initially. When it finally breaks, we continue to respect this mean, and then we have our volatility pop, our mean reversion to the longest overextended period. And immediately after that, we spent another month digesting in a compression range. And it follows it really well. Early on, it's not as wide, and that's typical. These tend to start less wide than they become, especially on higher time frames where they can last a while. But we keep getting near tags or tags of the pivot, and the best re-entry ultimately was in an area of pretty close to an exact tag, not quite an exact tag of the longest overexpanded period, 1.25 standard deviation, and not quite the tag of the 1.25 of the compression range, but pretty close. About, if your orders were layered in there, within 100, it was where it wicked to and where it was the best price for that trend continuation. Initial resistance when we start expanding again is at the compression range 3.2, and we take some time to actually break compression. It isn't instant. We tag it 3 different times. We come back down, but at this point we're holding this side of the pivot, and eventually we break out. The last area I really want to focus on this chart is to point out that the very large tracked compressed period, which, if you'll recall, is actually a larger period length being tracked than the 605 period length, longest overexpanded period here. This overexpansion is in fact happening underneath the compression pivot, or the compression period length. When it actually comes time to start crossing into the bands, both pivots get respected. I would say you should take the LOXP band more seriously in almost all cases. But we cross down, and then we find support on the compression band. Then we bounce back up, and where we find resistance is back at the border of the overexpansion band. And repeatedly, these bands served as support resistance levels over a time being, and we were trapped between them before we broke down into this range. At this point, it looks like we're going to end up mean reverting BTC USD at least to the longest overexpanded period mean, and possibly mostly laterally at this point. Certainly this mean is higher up than where the expansion started. What happens there is unknown as of the recording of this video, but to date it's following volatility pivots on the 4-hour remarkably well. And after, I'll have the comparison to the daily in the next tab. I want to show you two other 4-hour charts though. This is ETH BTC over a similar time frame, and this one is just an incredibly clean compression range. And there was a lot of back and forth about the ETHUSD price and the PTCUSD price in this particular area. This was the point where ETHUSD had its run to finally match BTCUSD after BTCUSD had its major move in May. And then we spent a whole month basically compressing that move on ETH BTC. We repeatedly found resistance on the center line. We repeatedly tagged the 2.2 standard deviation pivot here at a point of confluence with LOXP. We got a wick all the way down to it. That was after it made it to the top of the range. I couldn't close a candle past 1.25. Then it bounced back. I found resistance at the center line, 1.25. Briefly gets above the center line here. That's a bit imperfect. But we are generally respecting the pivots, and if nothing else, you would be able to identify that at least this area is going to be range trading in all likelihood. And even when the exact pivots are not holding because you get wicks above and below them, the fact that we're in a range and this is the center line and you would want to be entering long below it and short above it if you're going to enter at all is pretty straightforward. We finally break down. We break down in the direction of we break down the same direction that we exit. We just follow classically the 1.25 standard deviation bands. Again, both the mean reversion and compression bands get respect along the way. Start tagging 3.2 down here, and that's when we start getting choppy and bounce. We get to failed mean reversions here, which is interesting. I want to say there are daily pivots there. Are at this somewhere around the point where we were breaking out on the daily. I don't have that chart loaded in this particular video. But the general concept, this is just a clearly expanding range, is pretty straightforward. So this is just a clean example of a compression range that paid the pivots very well for a whole month and then breaks out into an expansion. The last chart I have loaded for a 4-hour chart here to show you. It's just one of my favorite charts for volatility theory, period. It's the Binance XRP Ethereum chart, and what makes this chart incredible is that this is just not a pair anybody actually trades. It's almost pure bot arbitrage happening. It doesn't really make sense to trade this pair because it means you have to expose yourself to holding less liquid Ethereum, less liquid XRP than BTC if you wanted to trade alts, or USDT or USD if you wanted to hold fiat or stable coins. So it's just pretty purely bots on Binance arbitraging relative movements of XRP and ETH happening elsewhere. And as a result, it just really cleanly obeys pivots, particularly expansion pivots. Enters pivot for mean reversion. Finds a dead cat bounce in here somewhere, but where it rejects is specifically the pivot for mean reversion again. It held a compression range for a time. It finds its bounce, the exact mean. We are tracking a new set of new overexpansion after we cross the pivot for mean reversion, where we compress this volatile bounce. We respect pivots along the way. We wick a confluent pivot. When we start continuing, it's a compression range under the previous tracked compression underneath the LOX-P mean. It's really. It's a good demonstration, and it's a good place to just look at it in a general sense of how markets move with respect to volatility. So the last two sets of charts I have that I want to show are the comparisons to the daily chart, and I've got these because there's a point I want to make about really high time frame compression pivots, which is that you've got to be really careful about using them as taking them too seriously as exact pivots. There's a certain amount of choppy movement as to what the exact pivot gets set at over the course of especially large daily bars, and it generally closes at a place that makes sense, but you really can't use it as more than just a general sense of where there's resistance. This comes from the fact that it's simply not all that precise to pick out the longest compressed period, and it starts mattering a lot when we're talking about really high time frame compression pivots, such that picking out a large range of pivots, you're picking out from a wide enough range of means that which particular one is best supported at that particular tick may differ too much from price to really sit an exact value. So it's not really being actively demonstrated in real time on this particular chart, but I want to get that warning out there that you should be careful when you see these extremely high time frame compression pivots. I will say for smaller cap altcoins, this higher time frame mean on the compression moving average is often a place of rejection in my experience during the bear market. It can be hard to pick out what levels altcoins are going to go to. I found this one to be surprisingly common and worth taking seriously. So ETHUSD, which compared to Bitcoin has been far more volatile and extended far higher period lengths in 2018, also got this sort of absurdly large compression range as a result of this final capitulation move that expanded along this overexpanded period out rather far. We might call this a weekly trend if there was actually enough data to be satisfied with the resolution we had for weekly charts. But despite the fact that this compression range, for a lot of its existence, was all the way from 90 to 250 in the 1.25, it held remarkably well as a set of pivots, especially this mean in the middle. For 2 months, really, after having tagged it back here, we basically saw it as resistance. And when we finally expanded, we pushed that mean up and we expanded this compression range even further. You could also take this chart as an illustration of the limits of compression as something to track, because this range now goes all the way from about 1,000 to 50 and 575 to 50. The higher bands as high as 1,000, the lower bands insignificant below zero. So at some point, it's nice that it's telling you that there are far out targets if we start moving in a parabolic manner. That would be the case when you'd start looking at this to try to help you figure out where confluent targets are. So if you're trying to figure out where you'd expect parabolas potentially to reject. But anything else, it's just too wide of a range to base your trades off of. And it's almost certain that as we bounce around here, the exact width of it's going to change much too. So it's information that has to be used just under specific circumstances where it's actually realistic we could reach out to those pivots in the first place.